as a trader, do you really know what a liquidity sweep is? This term manipulation or stop loss hunt.
Currency manipulation.
Currency manipulation.
Most traders will imagine a sinister belief of the puppet master, the elites controlling the markets, pulling the strings, all to take your liquidity. Now, apart from a cool story, this is not the reality of market mechanics. Because at the end of the day, the market is actually very fair and rather efficient. So in a very fair market, how can manipulations happen? What is going on when you see these very obvious stop loss hunts in the market? When large institutions, large players in the market, these institutions may be placing a single trade of tens of billions of dollars. So while my order of $5,000 risk might get eaten up by the market in a millisecond, these orders of tens of billions of dollars, well, they need a lot of counterparts. If this institution's buying this large amount, who are all of those sellers and where are they coming from at that specific time that they want to enter? Well, this is where the market will go out and create and find liquidity. Not sinister, more a necessity. Think of it as the big players are accessing more liquidity in the markets by presenting price in a way to invite in traders so that they can use them as their counterpart. So just for a moment, imagine you are one of these big institutions and you want to place this big order into the market and only half of it can be fulfilled. How can you get the remaining half of that $10 billion order? How can you get that remaining $5 billion? Well, you have to create a scenario or create an environment where you're going to invite in $5 billion worth of sellers. And how can you do this? Well, you look at the major strategies around. What are those beliefs that majority of traders believe in? One of them is going to be trend lines. Now, it doesn't take a genius to know what a trend line is. Those lines that everybody can see. You can learn it within minutes, you can draw it on a chart within minutes, and you can trade it within minutes. No expertise, no experience, no real edge. And when you look around on the internet, you will see so much content about trend lines. In fact, if you just type it in on YouTube, you will routinely find videos with millions of views breaking down how to trade a trend line. So if you can see a trend line, I can see a trend line, so can the big institutions. And importantly, trading is a zero-sum game. There is not money that is created or destroyed. It stays in a loop. It just exchanges hands. So when I win money in the market, somebody lost money. And when I lose money, somebody won my money. So it's a closed loop. So when everybody knows about trend lines, everybody's trading trend lines. 99% of retail traders know about trend lines, use trend lines, and we know that 99% of retail traders lose. Well, these are the people that are losing money that are allowing the big players to win their money, the big institutions. And again, this is not a conspiracy theory saying that they are going out of their way to hunt for your stop loss of $50. It's not about that. It's about mass manipulation of mass mentality and mass liquidity of mass retail traders. So back to that example of $5 billion of a buy order that they cannot find a counterpart to. There is not enough sellers in the market at that time, at that price. What they will do is they can show price action. They can create an environment to show a very clear trend line. And when that very clear trend line presents, you're going to invite in a lot of sellers who are going to be selling based on that trend line. So you invite in liquidity, and this is simply the big players creating an environment to access this newfound liquidity to be the counterpart for their large orders. Not manipulation, a necessity. And when these things regularly happen on a day-to-day basis that I'm going to show you through real chart examples of recent price action, you will see this is not an anomaly. This is the language of price. And when you start to understand this real market mechanics, what I like to call an inducement, these sweeps that invite, entice, and take out to help the big players access liquidity, a necessity that they have. Once we can spot these inducements, we are no longer trading one step behind. We're always going to be one step ahead alongside the big players, rather watching the digital signature of manipulations that the big institutions use to facilitate large orders. And when you can see these large orders in the market, well, you know that's a self-fulfilling prophecy. If a big institution buys a large amount, price will go up and I can catch a ride. And in this video, I'm going to be sharing with you what exactly a trendline manipulation looks like, how it presents, how it works, and how you can take advantage of it. And alongside this theory, I'm going to be showing you multiple chart examples so that by the end of the video, you have really changed the way you view the market and you'll never fall for a market manipulation or a stop loss hunt ever again. So let's get into it. The trendline trap strategy, where we understand that manipulation is inherent in the market. It's not a fallacy, it's not a conspiracy theory. It's a necessity. And the reason it's a necessity is because the big players utilize this to access liquidity in the market. And before we get into the trendline side, I want you to understand the market mechanics a little bit better. Number one, I spoke about the auction theory, which is for every buyer in the market, there has to be a matching seller for a deal to take place. And that's when there is a buy order and then there is a sell order and then you have a deal over here and then the market moves accordingly based on the agreed upon price. And then as buyers accept higher and higher prices, price will go up. Or if sellers continue to accept lower and lower prices, then price will go lower. So this is the market mechanics based on supply and demand. But there is also another layer to this. The second category is going to be the exit. And the exit is going to be, let's say I have a buy order of 100 units and I buy over here and my stop loss is over here. So as price comes in, I get triggered, perfect. I'm in a little bit of profit and the trade is not going my way, and eventually comes to my stop loss. At the entry line, I bought 100 units, and at the stop loss, I get rid of my 100 units. So initially, I was a buyer, and I bought 100 units, and when I hit my stop loss, what happened? I had to get rid of my 100 buy orders, and to get rid of it as I hit stop loss, what happened? I was a buyer who no longer wanted to buy anymore. I wanted to get out of the trade, and therefore, I sold off my 100 units to the market. A buyer who gets out of the market is now a seller. So not just a seller because I'm entering sales because I want to find a profitable sell opportunity. No, a sell order can also be a buyer who is no longer interested in buying. So when you see that there are sellers in the market, there can be many forms. It can be a buyer exiting. It can be an auction of a seller entering. It can also be different reasons. It can be someone that is scalping, someone that is investing, someone that is hedging, someone that is swing trading, someone that is scalping, someone that's entering based on fundamentals, someone that is actually utilizing the currency because they're doing an international trade. There are so many reasons and participants. So it's important to understand the categories so that you can understand what happens when there is a manipulation. So let's quickly define better what a manipulation is. It's an intentional conduct of designed or engineered price action to deceive or mislead other market participants. In other words, the market shows something that will invite in a trendline trader. For example, a very basic trendline like this. If the market engineers or designs price action like this, we know that at this other touch of the trendline, buyers are going to get in. So we engineered price to mislead market participants, specifically trendline traders, to enter in this area. Price action was created to invite in traders. And areas like this, I'm going to refer to as crowded areas. I'm going to show you in a moment what that means, why crowded market zones are very important, because there's a lot of activity, a lot of liquidity, and therefore, for the big institutions, perfect, because there's a lot of manipulation potential. And remember, when you invite in liquidity, not only can it be the counterpart, we also invite in their stop losses below. So we can actually use this as a whole dynamic or a little ecosystem of a strategy we can understand. And remember, this is not a sinister conspiracy theory that they're out to get you. No, it's simply the big players create environments to invite in orders so that they can be the counterpart. Because if they want to buy and everybody else wants to buy, who's going to be the sellers? If in a market of 100 traders, all 100 traders are buying, who are they going to buy off? It doesn't work like that. And a more healthy market is if you have 50 buyers and 50 sellers and they all interact with each other. So when you have a crowded market, for example, there is 90 out of 100 traders buying and then the big institution also wants to buy, this is going to be a problem because no one is there to sell. So they will create an environment to convert people into sellers, to invite in more sellers so that they can actually access the liquidity and find their counterparts. This is how the market works. Okay, let's move on to trendline theory. Exactly why and how this works, because I don't want you to blindly follow things. In fact, if you're a struggling trader, this is the reason you're in this spot, because you blindly follow things. You watch YouTube videos about support and resistance, trend lines, smart money concepts, and then when you have a few winning trades, you get hopeful and say, I'm onto something. And then when you consistently blow accounts and have losing periods that you don't understand, very easily you can fall into frustration, confusion, and that's why people either strategy hop or give up trading altogether, or the worst, they YOLO trade on prop firms, hoping to get a payout to get them out of their misery. This is a repeating cycle that I see all over the internet, all over the trading community, and it's very frustrating. And a big reason for this is because they trade blindly. They just follow people blindly, and they don't take a moment to check, who am I learning from? Are they even profitable? Have they shown any proof or consistency? And then what I'm learning, can I back it? In hard times, when my emotions are high, when I'm in a losing period, can I still take that trade that is part of the plan with conviction? If you don't have the market experience, the backtesting data behind you, or even the understanding of why you're doing it, in hard times you will not follow the plan, and those trades that were supposed to get you out of drawdown you won't take, and you'll end up spiraling further and further into losses. It's very important to follow that 3-step plan of understanding the why, the wisdom of why your trading strategy works, because it's found in correlation or causation. Correlation is just something seems to happen, like an RSI or a Fibonacci. It's just a zone that something could happen. A causation is the reason why. These things cause the market to move. You should be on this camp. Then you should have market experience. This can take years to develop, something that you can't do right away. But backtesting and data, if you see a trade repeat 1,000 times in backtesting, you are more likely to execute correctly in the real markets because it's just another day in the office. You've seen this 1,000 times in backtesting. And then of course, the more data you have, the better armed you'll be, because it's all about psychology and confidence to adhere to a plan. So this is why I want to take a moment to explain these things better. So day one of trading, what do you learn? You learn about trend. You learn about a sequence of connected higher highs in the market with a sequence of higher lows in the market. Connected together becomes becomes a trend. And then day 2 of trading, you start to realize, okay, with that trend, I can connect 2 dots, 2 consecutive higher lows and extend it out. And I formed a trend line. And then you start to learn about how you can enter upon these trend lines, and you can even add in Fibonacci levels from the high to the low. And this area could be a Fibonacci level. You throw an EMA, and then you've come together and found a zone to enter based on a trend line, based on a fib level, and based on an EMA. So this becomes the confluences that a lot of traders are entering upon based on things crossing together, where zones of retail traders will be crowded, because a lot of retail traders are trading support and resistance, trend line, market structure, supply and demand, EMAs, indicators, Fibonacci, all of these things majority of traders are using. So when you have majority of traders entering in this zone, then you have found a crowded market area. And with a crowded market area becomes positive, because this is highly manipulated or highly targeted, because the institutions can see it very clearly, not only from the strategies, but also from the order book, because these institutions are usually liquidity providers. They can see from all the brokerages connected to them, where are all the retail orders placed, where are their stop losses placed. So this is nothing new to them. This is something that they can see clearly. And when they can see a lot of retail traders are entering in this area and a lot of their stop losses are right below, why wouldn't they just shoot price lower, grab the stop losses, and then go higher without them, using them as exit liquidity, using their liquidity along the way to help them access the large orders that they wanted to place. This is not manipulation in a sinister way to say they're going out of the way to get you, because the market in the end doesn't care about your stop loss. They look at mass liquidity, mass strategies, and mass participation, and these people are usually mass losers in the market. So when you connect the dots together, it all makes sense. And once again, I'm not trying to convince you, I'm just showing you the evidence, showing you the theory, showing you chart examples in a moment, and letting you come to your own conclusions. Because trend lines, I'm sure a lot of you have traded, a lot of you believe in, and this is a little bit painful to see someone that's saying, hey, this doesn't work. And I'm showing you the whys and the hows, and I'm going to show you how often this happens pretty much on a daily basis in just a moment. But now, step 2. So we spoke about step 1, which was the auction side. What about the exit side? So let me explain that one to refresh. When people get into the market and then they hit stop loss, the buyers over here, to get out of the market, become sellers. A stop loss means a buy trade that hits stop loss now becomes a seller to get rid of their trade. So you can see how sellers can get into the market to be the counterpart for the big institutional buy that we spoke about of the large order. They become counterparts to each other. A buyer getting out of the market becomes the seller needed for the big institution to buy up the big orders that they wanted. So this is how the manipulation process begins. When we see that a zone where a lot of people will be getting in, let's just simplify it and say trend line, we're going to invite in their orders. Their stop losses are naturally going to be right below in this area. So if the institutions can drag price lower, then we take out their stop losses and they say, thank you for that liquidity. We needed these sell orders so that we could buy it up and be your counterpart. Perfect. Objective achieved. But why stop there? They can go a lot further. Think about it. What do trendline traders learn? They learn about trends, and then they see when a trend breaks, they look to enter upon the sell. So they'll be buying along the trend line. When the trend line breaks, they'll look for sell opportunities, but only when they see a test of the trend line and then a continuation lower. So it's called a break test continuation. And what they are going to be doing is they're going to be finding the zone that led to the break of the trend line. This area broke the trend line, and they'll be entering once again upon the trend line, so resistance level, Fibonacci level, EMA level. Maybe it'll be a candlestick pattern like a doji. It doesn't matter. We just know this area is going to be crowded because a lot of sellers will be getting in based on the trend line break, and the stop losses will be right above, naturally so. So when the institution comes along and says, you know what, we wanted more sellers in the market, we are now inviting them in through the break of the trend line, we are now going to shoot price higher and take all of them out. So now we get a double whammy. We took out everyone in the market. We took out the buyers, we took out the sellers. You might be thinking, why would they take out the buyers that are on their team, these guys that are hitting stop loss over here? Advanced tip, but you realize that these sellers, when they hit stop loss, they become buyers. So when they become buyers, they accelerate the process. When the market is ready to move higher, these are now becoming the catalyst. They're becoming the domino effect alongside the institution after the institution is in. The institution is in down here, and then anyone else that joins that team, well, it's better for them because it's the wave that helps them arrive to their profit level. So put simply, at a touch of a trend line, buyers get interested. And when buyers get interested, their stop losses hit right below. And then the institution comes along and says, hey, we need more liquidity. Let's access it by breaking through these stop losses, breaking through this obvious trend line where a lot of traders are getting in. Let's take their stop losses. And in doing so, the double benefit becomes that though not a lot of sellers are going to enter in this region based on the trend line touch of the break test looking lower and other reasons like Fibonacci and break of structure and whatever. And these sellers' stop losses are going to be in this area. So when the institution has done their manipulation, they have now got their big order into the market. They're ready for price to fly higher. They get more sellers in this area. They load up their last orders of buys from these sellers, and then they shoot higher, and now these sellers get out of the market, their stop losses, they become buyers who join their team, and price rockets higher, which is why you see after a large order from an institution plus the catalyst buyers, you should see an aggressive move higher, which is why my trades are always tap and go. When I get into the market, I don't wait in drawdown for days and weeks. I don't consolidate around my entry for hours and then make emotional decisions like jumping out and entering again when I shouldn't be. This is emotionality based on not understanding timing the market. But when you enter the market and market flies in your direction, psychology doesn't matter because it's easy to take profits. And you know within minutes, literally minutes, if I'm going to hit stop loss or take profits. In fact, my average trade time to hit 1 to 3 risk reward is usually 15 minutes to 30 minutes on average to hit a 1 to 3 risk reward, and the average time to hit a stop loss is usually 10 minutes. So within 10 minutes, I'm going to know, am I break even, stop loss, or hitting a 1 to 3 risk reward? Psychology becomes a lot easier because of tap and go, because you're with the market, you're with the momentum, you're with the big players, and it's easier to trade because it's an instant feedback loop. And it's for the reasons of these market mechanics. Once the big player is in, you expect a bigger reaction because once so many buy orders enter the market must go higher, almost a self-fulfilling prophecy. So if you can correctly find these inducements, this big area that invites in traders and takes out stop losses, a mass manipulation known as an inducement, if you can find these areas, you can trade very high probability, high win rate, high risk reward with momentum on your side. And I'm going to be showing you all of this in just a moment with chart examples. To finalize this point, a trend line touch is not a buy opportunity, and secondarily, a break of a trend line is not a sell opportunity upon the test. These are retail mentalities, retail strategies, and 99% of retail traders lose, so don't follow the masses because it does not work. So instead, realize a touch of a trend line is a potential manipulation zone, and a test of a trend line after a break of structure becomes a catalyst for price to go higher, not lower. So in my trading, how do I utilize this for my advantage? Well, I come down to my trinity that I always speak about: time, lower time frame confirmation, and inducement. When I see this trinity, it's a high probability zone for me. So number one in the liquidity cycle is you have a build-up. A trend line is a form of build-up. When I see that build-up, I look at my clock and say, hey, are we at London Open? If I can see myself at London Open, and I can start to see price manipulate upon my key time window, and I can start to see rejection. For example, a rejection type like a minor inducement break of structure entry zone for me, where we see a minor inducement of that higher low that made an internal higher high, and we overall saw an internal break of structure like this. Then I know I have found a lower time frame confirmation type that I like, where I have an inducement low that led to a break of structure higher, and that can be my buy zone, where I buy over here, and my stop loss very nicely goes at the low. Now I found an entry and stop loss, and my target can be just breaking past this trend line high over here to make a higher high. So now I have a trade locked and loaded, and it's very simple. Price comes lower, comes into my entry, and goes towards my take profit level, usually with the average session volatility. This is why it's powerful. When you're focusing on time, lower time frame confirmation, you can have a higher win rate because you're trading at the right time when manipulations are most probable to happen. When the big players come online, this is big opportunities to get into the markets after a manipulation. So I wait for the inducement, I come to my time window, and I wait for a rejection to confirm this is a low and I'm not just catching a falling knife. Once I have that, then the session volatility kicks in and price moves more aggressively, usually 30 to 40 pips on EU and GU during a London Open. That's the average movement in that hour, in that open. So if I know my average stop loss based on M1 rejection is 5 pips and the average London movement is 30 pips, well, I can very easily catch my 1 to 3 because I just need from my 5 pip stop loss a 15 pip take profit. 1 to 3 risk reward can be pretty instant within the average session volatility. I'm not hoping and swinging for the fences. I'm not hoping price rockets from here. I'm hoping price does what it always does: average movement. And if I can find this pockets of probability of average movement that leads me to high win rates and high risk to reward with the average movement based on manipulation, momentum, institutional intent, this is the best way to be trading because it's not a correlation, it's a causation. This is a must. To access liquidity, the market does this. And when you have big liquidity, you have big reactions and you're at the right time. This is perfection, which is why after a decade of trading and learning all types of strategies, this is the one that I chose. This is the one that I stick by. And this is the one that has made me millions of dollars in trading. This is the way to be trading, which is why I'm passionate about it. By the way, if you're enjoying this kind of breakdown and you want to see more insights in this level of detail, in fact, 10 times higher than what I've prepared for you, is a free 3-day course. This is high quality production with professional slides, diagrams, chart examples to take you from any level, from zero all the way to a profitable scalper. A full blueprint, absolutely for free. All 3 days will be sent to you directly to your inbox and there's no catch. All you need to do to download this for absolutely free is to message me on the www a trading Instagram account, just message me the word course and I'll send it to your inbox directly. Right, so now that we've understood the theory and the dynamics of what goes on, let's jump into some chart work and see it in action from recent price action. Okay, so let's walk through recent price action from a recent Friday all the way down to the present moment. I'm going to walk through all of this price action and show you how often traps present in about a 2-week period on one currency pair, this one being GBP USD. So first of all, it's important to understand the framework because I'm not just trying to draw lines and find every trend line and trying to convince you. I'm trying to show you relevance. So I'm trying to show you an overall trend. And when that trend presents, we find you the opportunity, for example, like this. And then when that trend breaks, then we see a new trend form. We're going to find you all of the opportunities of those ones getting induced. So I'm going to try and show you a framework alongside trend. So if we see a bearish push in the market, that becomes our range. And then inside of that range, we look for manipulations like this. And then inside of that range, let's say we see a bearish trend line present like this. Before price goes lower, it might sweep higher, take out that trend line, invite in the break test continuation buyers, but in fact shoots lower. So then this inducement became the sweep of the trend line liquidity. And then also the people that were buying based on a break of structure, test of this trend line, etc., they also got taken out. A manipulation based on a trend line within a framework of a trend. So starting off just like this at the beginning, by the way, the indicator you see on the screen, which is basically showing the Asia range, the beginning of Asia, the end of Asia, the high of Asia, and the low of Asia. And then you see these purple dotted lines. This is Frankfurt open, manipulation time, London open, key time window, gray box for my kill zone of when I'll get in, New York open, another trap time, and then New York key window, another execution time for me. So in a previous video, I walked through how all of the inducement types can lead to time-based, inducement-based opportunities. And these were the ones that I walked through in my last video. But today I'm going to be showing you alongside the trend lines. So first we can see we are in a bullish trend. We are forming higher highs and higher lows. And I mark out demand area like such for later on. Here we can see, this is very obvious. We see a trend line forming. So many touches of this trend line, 1 touch, 2 touch, 3 touch, 4 touch, etc. When we form a high hitting a supply zone on the left, what happens? We start to break lower and we form this low in the market. We found a range and already within here, my eyes cannot unsee it. I'm seeing resistance level, inducement, trend line level, inducement, another trend line. We're going to see it all over the place, but I'm going to focus on one thing, which is just my trend line liquidity inducement. Now that we've seen this trend line number 1 fail, so let's mark it out and just remember trend line number 1 has failed. Then as we see price move forward, we start to see this trend line of 1 touch, 2 touch, 3 touch. So this one is getting manipulated. Here we see another trend line, 1 touch, 2 touch, 3 touch, 4 touch here getting manipulated. So let's mark these out. I'm going to clean up all of the excess from the previous video of all the trades that I mentioned from the inducement types, but we can see clearly now we had inducer number 1 of this trend line getting taken out, inducer number 2 of this trend line getting taken out, inducer number 3 right here of this bearish trend line getting taken out, and then we continue on. Over here I see when we make a decisional demand area getting swept, we had a 1 touch, 2 touch also getting swept over here. So this becomes our 4th inducement. Then we see this trend line, 1 touch, 2 touch, 3 touch, etc. And then eventually that gets swept over here. So our 5th inducement. Remember, it's all inside the framework that I was speaking about, where we see a bearish push in the market, we see the trend line associated with it, and we see an inducement of that trend line. People will see this inducement. What they're going to do? They're going to be selling on this trend line, stop losses all around this area, all the way up to here, potentially, all of those getting swept out. And then they're going to see the buy opportunity, buy on the test of that trend line, look to continue higher. They also get taken out. So it's literally mass manipulations all the time. And already in the space of a couple of days, we've seen 5. Next, what do we see? We see this bearish push down. We see the complex pullback retracement, 1 touch, 2 touch, 3 touches of this trend line eventually should go on to fail. What does happen after a high of previous day inducement? Another concept for another time. We can see that inducement led to that trend line breaking. So let's mark it out. Another failed trend line touch, and that was inducement number 6. The next one that I want to focus on is down here. We can see that we had a bearish push. I marked it out, bearish leg down, and then we see there is mass manipulations. Number 1, because we have all of this bearish trend line activity. Forget the support and resistance stuff, but we can see another manipulation right here of this trend line right here. So if I'm not wrong, I think we're on number 7. And then on the other side, we can see the buyer's opportunity, all of that, 1 touch, 2 touch, 3 touch, etc. Also getting out, another inducement right here, becoming number 8. And this brings us on pretty much to the present moment, which is today. Now, this is a quick walkthrough just to train your eyes to see how often trend lines present with the trend, also against the trend, and how often they fail. Now, the alarm bell might be going off in your head and saying, well, I also know these traders that are utilizing trend lines and they're profitable. Again, this is not about picking exploiting the anomalies, because the anomalies and the exceptions do not define the rule. Here we need to understand mass psychology, mass strategies, because mass traders lose, majority of traders lose. So if we understand what the majority are doing, we can understand where the majority of liquidity is, where the majority of traps are. So it's not about exceptions. It's not about finding one or two good trades in here that worked. Even sometimes a trend line will work temporarily because you have to feed the retail traders. If retail traders took trend line trades and always lost, then they would never take those trend lines. So you have to show them just enough for them to win, for it to be a zone to invite in liquidity. If it never worked, there would be no invitation of entries. So you have to show it, but not enough for it to be profitable, which is why traders can see trend lines, they can backtest trend lines, they can find profitability sometimes, but they can never find consistent profitability on trend lines alone, unless they have an edge in other ways, a psychology edge, a money management edge, a risk management edge, or most importantly, a fundamental edge, because trend lines become execution points. And if your trade idea is based on macroeconomics, geopolitical factors, the COT reports, and your long-term swing trading based on fundamentals, and you use the trend line as an entry with a large stop loss, they're not going to get manipulated out by these inducements of 10, 20 pips, because they might have a 100 pip stop loss and hold a trade for 6 months. Completely different category, even if they're utilizing trend lines. But when you start to see this, I encourage you to go and backtest and see this time and time again. Go and download the 3-day course that I have for you. You'll see example after example. Once you see it, you cannot unsee it. And most importantly, a restricted trader is a profitable trader.